there are a whole host of digital health solutions, and I know you're quite familiar with, that might have a long-term value impact, but it's harder to show the short-term value impact. And in the absence of showing short-term ROI, a lot of those companies are struggling a lot more.
I think is like a common misconception is that, a lot of people think that employers aren't looking for innovation. And what we say is that they actually are still looking for innovation. They just want to purchase it in a way that makes sense for them. To your point, they are having like these massive cost increases. Like they need to do new things to get ahead of this, but they need to purchase solutions in a way that, makes sense and is manageable for them because these are not like huge HR teams with like, massive amounts of people to really manage, a ton of different vendor solutions. It needs to really make sense. Welcome, everyone. Thanks for joining today. Today, I have with me John Zutter. He is the CEO of Lantern Health. He joined Lantern in 2016 and has since taken the company from 100,000 members to over 6 million members. So Lantern is a leading digital health company in the employer space. They bring specialty care to millions of lives, as mentioned. John has a background as an investment banker, which is kind of interesting that he entered into the healthcare industry as an outsider. So thanks so much, John. I appreciate you joining today.
Thanks for having me.
Awesome. Well, I'll dive right in if that sounds good. So, John, would love to hear a little bit about your background as an investment banker and really like what drew you to healthcare and this opportunity with Lantern when you joined in 2016.
Yeah, so I certainly have a meandering path towards healthcare. I started out as an investment banker in New York at JP Morgan, more specifically focused on financials and subprime finance within that. So during the financial crisis, I was focused on subprime mortgage and subprime auto and a variety of other parts of financial services. So, you know, leading towards a ultimate career in healthcare, I'd say at that point that was pretty unexpected. I left banking after a little less than 10 years of doing that to go to industry to a company that we had helped take public. And from there, I left with the founder to help formalize his family office and do both private equity and venture capital work. This was in 2014. One of the first companies we made an investment in was the predecessor of Lantern, at the time called Employer Direct Healthcare. And ironically, I actually voted against investing in the company and got overruled. And I'm glad I did.
That's funny.
But in the short period of time after we bought a majority stake in the business really went through some tough times. So we lost about half of our clients and half of our membership in the next, call it 6 months. And Lindsey, as you know, it's pretty hard to lose clients in the middle of a plan year. You have to be doing something truly extraordinary, especially to do that consistently. And so that was kind of the starting point for my participation in healthcare. I didn't know much about it, but drew the short straw of trying to figure out if we could fix it. And so I took the seat that I'm in today in December of 2016 to try and first just understand what did we have and could we turn it around. And at no point did we think I was going to stick around for any material piece of time. We thought we would either hire someone to try and lead the charge forward, or the business wasn't going to make it. And for the next 4 years, I tried to learn as much as I could about healthcare as we turned the business around and started growing. And then from there, we've had a variety of capital rounds and new product offerings, and a lot of good luck and timing that helped us throughout that journey. So when I joined in December of 16, we had about 100,000 member lives, as you noted, and today we're fortunate to have over 6 million. We went from about 15 clients to hundreds of clients. And, throughout that time period, I had the good fortune to learn a whole lot about what works in healthcare and equally what doesn't.
Yeah, absolutely. I bet. So curious then, when you first came in 2016 and you're new to healthcare, new to working with employers, like what really like stood out to you? I think that I met you not too long after that period when I remember that you were kind of fresh into the space and questioning some things about how healthcare operates.
Yeah. So people often ask what's similar and different about this versus some of your past experiences. And what I'd say is, you know, healthcare and financial services actually have a bunch of things in common. At the top, you've got a fairly concentrated set of established players. In the bank world, there's a few that everyone knows and loves, and pretty concentrated. Similar in healthcare with the Blue Cross, United, Cigna, Aetnas of the world. You've got a tremendous amount of regulation at local, state, and federal levels. That applies in both. You've got a lot of very sensitive data that has to transfer around, and you have to be very thoughtful and treat that appropriately. Whether that's personal financial information on the one hand, personal health information on the other hand, and that data is not always clean and it doesn't talk to each other very efficiently. And so, how do you homogenize that and analyze that? So, you've got a lot of complexity in both places with a combination of fragmentation and industry consolidation, regulatory overlays, and data overlays. So, those are some of the similarities between it. When I first got here, I think I was surprised. I was surprised at how important an issue it was, but also how far away it was from kind of core decision making at a lot of the large companies, right? In terms of the amount of dollars at play, generally speaking, are the second largest P&L line item after salaries for most employers in the United States. But it's often, not a decision that's made with the same degree of significance, right? It's often several levels down from the CFO or the CEO where a lot of those financial decisions are made. So that was a surprise at first. Another was just how far people were from being able to really show the impact they made versus the claims of impact. And so we did a whole bunch of work to try and figure out, did we actually make a difference? Like, did our solution drive change from a financial perspective? Like, was the value prop actually what we said it was? And kind of went sequentially through the different parts of the business over the years to say, do we actually drive value? How do we actually deliver it? How do we think about go to market? How do we think about marketing? How do we think about engagement? And so kind of going, business unit by business unit within the organization and trying to figure it out. And it's been kind of a long journey towards understanding healthcare. But at the end of the day, I think while healthcare is very personal and it's very complicated for the reasons we talked about, it's also a business the same as anyone else where you've got to motivate people, you've got to think about analytics, you've got to think about evolving technology, you've got to think about what's in it for your customer and for your counterparts. So a lot of similarities there as well.
Yeah, I think that's super interesting. And I think it's interesting that you touched on the fact that, especially like working with a lot of the large employers, those decision makers are not necessarily at the top levels of the organization. Oftentimes, you're dealing with somebody in HR or benefits who is kind of a mid-level decision maker. Oftentimes, I've recognized that as being, something a little bit unique about the space as well. Do you think that's changing at all with the larger employers? As they're thinking more about their budgets and how healthcare can be a bit more strategic for the organization?
I think they have to, right? So in this economic environment, healthcare typically grows at about twice the rate of inflation in general. And so when inflation ticks up as it has over the last number of years, that makes already a growing problem one that's a real problem that gets a lot more focus. And so we're seeing that there is a lot more attention being put on the line item. Now, whether that attention gets to participation from higher levels in day-to-day decision making or in strategic decision making, or it just informs kind of the direction they're giving their teams, I think that varies a lot company to company, and we certainly see that across a pretty broad continuum. But the focus area on this P&L line item is certainly gone up, and that's causing a change in behavior in the way people are thinking about the provision of benefits, across the U.S. workforce generally. We're seeing people be a lot more prescriptive and thinking about where are they going to try and guide and direct people with a little bit more intentionality, and also just how much can they afford to bear in terms of costs, and that's leading to good things and bad things. For example, there are a whole host of digital health solutions, and I know you're quite familiar with, that might have a long-term value impact, but it's harder to show the short-term value impact. And in the absence of showing short-term ROI, a lot of those companies are struggling a lot more. I think it's a challenging environment to be a digital health company that doesn't have the ability to show concrete ROI in a pretty tangible way.
Yeah, I think that's really interesting. And that kind of segues to my next question. So obviously, the company has grown dramatically. So you've gone, like we said, from like 100,000 lives to over 6 million lives. I read on your website that you've saved employers, over $1 billion. So having that hard dollar tangible ROI, I would assume is probably part of that catalyst for growth. But we'd just love to hear kind of your thoughts on, why, the solution has really resonated so much in the market and what's kind of, helped you grow to this point.
Yeah. So I said, as I started this journey, I kind of went sequentially and learned my way through healthcare. And I started with what I knew. And so coming from a financial services and investing background, I kind of started looking at the numbers. And what I saw very clearly was that when we engaged people, we drove pretty substantial cost savings, but the degree of engagement varied a lot. And so we had to very clearly prove that out and earn the right to communicate more to members, to put in place other incentives to drive greater engagement, to make the overall results both more sustainable and more impactful for our clients. And while we did that, I think what we observed out in the marketplace is similar range of success for other solutions, both with respect to time horizon, where changing people's behavior at a population level takes a really long time and it's hard to measure, and some solutions that just maybe have less of an impact. They're more of a feel good kind of recruiting and retention type of tool. What we've seen out there and what's really driven our success is a couple of things. One is being focused on being able to show real tangible impact. And when we can drop unit costs by 55%, by steering people to high quality and more affordable care, by being more appropriate with respect to site of care, by using bundled payments, things of that nature, those sorts of things you can do the math on and show. So that's one. The other is really being thoughtful about the parts of healthcare that you play in. And so healthcare is very concentrated in terms of the spend. 1% of people generally are a third of costs, 5% are about 60, 10% are about 85. When we started, we were in surgery and in a narrower set of categories. We've expanded over time to be basically all plannable, medically necessary surgeries. That tends to be about 20% of spend. Then we entered into the oncology space. That's another 15 to 20, sometimes higher. And infusions most recently, which gives another 5 to 10. So between those three categories, we're talking about half of the overall spend for the employer, and the overwhelming majority of where the growth is. And so the first was being able to show a real impact when you're engaged. Second was try and engage more. And then third is focus on the areas that are where the biggest problem is, both from a compositional perspective, and that's specialty care, but also a growth perspective, which is the same. And I think that's really been a differentiator between ourselves and some of the others that haven't had the same growth experience, which is, are they able to show the results? Are they able to articulate and quantify those results? Are they able to do it at scale consistently? And is it big enough to matter, for that employer? There's so many different parts of healthcare that have opportunity to be more efficient, to be a better experience, but there are very few that have as big a dollar impact in such a targeted way that is so readily achievable.
Yeah, no, that makes sense. And I think that it's really key that you mentioned engagement as well. So many companies, we meet with a lot of companies that are like newer to the employer market, and the way that they're going to engage the actual end user, the employer or the employee, is oftentimes like kind of an afterthought. And so we're always coaching companies like, hey, you need to have a member engagement strategy that needs to be really built into what it is you're doing foundationally as a company. Do you have any just kind of like lessons learned or recommendations there in terms of like what you've seen work well for engaging these types of populations?
Yeah, so it's very interesting in that in some ways, healthcare, by virtue of its complexity, allows us to be a little bit behind other industries and learn from them. And so, there's a lot of things that people do in the consumer space and the digital space that we can adapt. And I think we're only really starting to. Targeted marketing is an area that, believe it or not, is not particularly penetrated in our space, right? It's not as pervasive. I think that's for a variety of reasons. One is the confidentiality and sensitivity of the information, not wanting to feel big brother, et cetera. But healthcare is also kind of very rules based and very progressive. Like doctors follow protocols, and those protocols are observable in the claims activity, and so it is in some ways fairly predictable. So I think there's a whole lot that's only we're really only scratching the surface, but it's also, I'd say, at a higher level, there's a few things that are learnings that are fairly pervasive. One is often the employee may or may not be the actual day-to-day decision maker for healthcare in their family. And so it's important to not just think about the employee, but also think about communicating with the home.
100%.
Demographics will impact the way in which engagement is more or less successful. So when you have more blue collar, more rural populations, often physical mail is still quite effective. Whereas with more white collar, younger demographics, digital is going to be a much more effective strategy. And so you have to be omni-channel, but you should tailor appropriately. Frequency matters. People aren't always thinking about what they're going to need for their healthcare tomorrow. And so you kind of need to be just in time. That's where the targeted marketing is very helpful. But without it, you need to kind of have a regular cadence because you want to be just in time for when it is relevant for that person. And longevity matters. So if there are marketing strategies that stick with you or have some degree of longevity in one way or another, I'll give an example from a past mutual client of ours, right? This is a very rural population, more blue collar population. Magnets worked really well.
Mm.
They sat on the person's fridge and they were a reminder every day. And so it gave you that longevity in terms of something you sent to their home. It might hold up a picture of the employee's son or daughter playing soccer or whatever. And so that's a little counterintuitive that something like that would actually work. But with that demographic, it actually does. So being thoughtful in that way as well.
Yeah, no, I think that makes a lot of sense. I mean, I think that, yeah, without having that plan to drive engagement, there's no way to deliver those outcomes or ROI. So it's just so fundamental to really being successful in this space. Switching gears a little bit. So I think that, and if I had read the last capital raise you guys went through was 2023. You raised, I think, 90 million on a $1 billion valuation. You've obviously grown, since then as well. But curious kind of like what your investors have seen as being the opportunity within specialty care for employers. I speak to different people that say, there's different investor appetites for the employer market within healthcare. Clearly, your investors saw there being a very strong opportunity. So I'd love to kind of hear your perspective.
So the investor markets have certainly had ups and downs over the last 10 years for digital health and the employee benefit space. I think the thing that has positioned us well across each of those moments in time has been kind of a focus on business fundamentals. And so, we hit profitability, quite some time ago. We've been able to consistently grow, but grow sustainably, without the need for additional capital. The raise you're referencing in 2023 was 100% secondary, meaning Insight was buying out existing investors and joining the ride, but not putting money into the company because the company was self-sufficient. And so I think when you think about the really high valuations that people talked about a number of years ago and it being harder today, the thing that has been a consistent differentiator is when you can have growth and profitability and kind of sustainability over time. So those sort of core business attributes, I think, are the thing that's positioned us favorably. A large overall target addressable market, of course, is important. Attractive unit economics from a gross margin perspective, of course, is important. But operating the business with that frugality, but also with that same growth mindset that leads to profitable, self-sustaining growth, I think has been the differentiator.
Yeah, that makes sense. That makes sense. You mentioned also earlier, that obviously you guys started off with more specialty care and then with surgical care, and then you've expanded into cancer and infusion, and you're really looking at kind of like what's going to like move the needle the most for employers for kind of what you're looking to expand into. Are there other categories that are kind of on your radar that you think are interesting for future growth for Lantern?
I think that one of the biggest entrepreneur traps in our space is expanding into categories for the sake of expanding into categories. And so I think it's more important to think about being disciplined and staying in your lane unless you have a real reason to expand. And so for me, when we say that specialty care, the areas that we talked about earlier, those three categories of surgery, infusions, and cancer are about 50% of spend, and they're growing at twice the rate of overall healthcare. We don't need a bigger TAM, right? We don't need a bigger market. That market is already enormous. We are by far the leader in our space, but we're barely market penetrated, right? And so we have an enormous amount of runway in front of us. And so I think the bar for getting into other categories has to be really, really high, right? It's ironic, right? You have to, on the one hand, to be a successful leader of a early stage or growth stage business, you have to be pretty dynamic. And so in some ways, like being ADD like I am is kind of helpful in that regard. But it's also a little bit your Achilles heel if you don't control for it, right? And especially in healthcare where there's a shiny box there and a shiny box there of all these things that are broken that we want to fix. So for us, we try and deploy like heuristics around what makes sure we stay in our lane. For us, like, is it those rare moments that really matter? So low frequency, high severity health events. Are they large aggregate dollars? Is there a lot of variability in cost and quality? Do we think that we can make a difference? Is it impactable? Subjective, perhaps, but like with our judgment, for us, being a TPA and being able to pay bills has been and build networks has been part of our differentiator. So our last of those 5 steps is, does it require some degree of in-person fulfillment? If it checks those 5 boxes, it might be interesting to us. If it doesn't, it might be a really interesting area of healthcare, but better served by another, great company out in the space. And so, you look at some of the places we've chosen to partner. We partner with some of the folks that do virtual physical therapy because it doesn't check all those 5 boxes. And there are other folks that are great at that, and they can be partners, and we can integrate with them and help clients get access to those services, help members have a cohesive experience, but we don't necessarily need to own it. And so that's kind of how we stay true to where we are. Specifically answering your question, I think we've got our plate full with our 3 things, and we want to kind of stay in our lane and execute against that for a while. There are some emerging categories kind of over the horizon. Cell and gene therapy is an area where I see a tremendous amount of potential for increased spend, and employers are going to need strategies around it. And so we'll keep thinking about those things, but for the next 12 to 18 months, I think we're going to stay in our lane.
And that makes sense. I love that you guys are taking such a structured approach. I think that's necessary. Your ADD comment spoke to me. We even struggle with that in our boutique consulting business. So I certainly understand. Well, you and I have both spent a lot of time kind of working with jumbo employers also over the years. We talked a little bit about, kind of the rising costs of healthcare for employers and how there's, perhaps more scrutiny from a budget perspective at the jumbo employers now. Are there other things that you think have really changed much within that jumbo employer landscape over the last 5 to 10 years, especially with like there being the explosion of all the digital point solutions and it just becoming a more crowded marketplace?
Yeah, so I think the bar has gone up in almost every way, right? And so Peterson Center, for example, has done a variety of analyses on different categories within the employer space and showing the efficacy of solutions. And I think, some of that work has highlighted that some things work better than others, and employers have taken note of that as well, either through their own experience or through third-party works like that. And so I think it's really hard to start today, right? People don't want to be a first mover. There are select clients that will always be kind of out on the forefront of innovation, but first mover dynamics today are definitely harder than they were 10 years ago. The bar for showing that your product actually works is harder. The approach to fee models has changed. It used to be that some clients liked the predictability of fixed fees, and others wanted variable pay for performance models. I'd say the market has dramatically moved towards pay for performance with, ever increasing ROI guarantees.
Mhm.
And then other benefits to scale. There's increasingly more rigorous standards around cybersecurity. and some of the, just requirements for maturation in your business to be able to interface with a large employer. And I think that just makes it that much harder to be earlier in the journey and find success with jumbos. The last piece I'd say is this isn't new, but it's maybe gotten worse, is vendor fatigue,
Mhm.
right? The majority of large employers have a fairly large number of different solutions that are helping their employees, whether it's with benefits or retirement savings or other things like that. And managing all of them, especially when a bunch haven't been successful, is just, it's a lot. And so employers are looking for ways to consolidate that. And sometimes that is looking for solutions that can do a little bit more. And that's driving some players in the space to be more platform oriented and, think about doing more and more and more. And we talked about the balance there of do more versus stay in your lane. The other is how they go about purchasing things. And so increasingly, to the extent that an employer can buy a solution or buy a set of solutions, whether that's through their health plan, whether it's through another aggregation entity, that reduces some of the burden to be able to try things out. And so we're seeing a lot of movement in kind of how does indirect distribution work in a variety of different directions. So we have products that are through some of our partners that employers buy through us, and vice versa, where through other partners, they can buy our services through contracts they have in other places. But contracting consolidation is certainly a theme that continues to progress.
Yeah, I love that you brought that up. We talk about that a lot because we work with companies oftentimes on kind of like what are the best pathways into kind of the employer market, like looking at it more broadly. But one of the things that I think is like a common misconception is that a lot of people think that employers aren't looking for innovation, and what we say is that they actually are still looking for innovation. They just want to purchase it in a way that makes sense for them. To your point, they are having like these massive cost increases, like they need to do new things to get ahead of this, but they need to purchase solutions in a way that makes sense and is manageable for them, because these are not like huge HR teams with like massive amounts of people to really manage a ton of different vendor solutions. It needs to really make sense. So
And they need to work.
yes, yes.
And they don't want to be the test case that's paying for the product market fit work of the solution. They want it once it already has product market fit and efficacy.
Proven solutions. Yeah, absolutely. Absolutely. Well, kind of the last question then in closing that I have for you is, as you're thinking about kind of the employer market over the next like 3, 4, 5 years, what's like one curveball that you don't think that employers are quite ready for that's maybe coming their way?
I'm not sure it's a curveball because I think it's a continuation of a ongoing theme, but the rate of change in how healthcare is delivered is only accelerating, right? With what's going on in biotech and AI and novel therapeutics. And, so there's a transformation that's happening between more procedural care towards more therapeutic care. And especially in the early life cycle of some of these treatments, they're incredibly expensive, but the use cases for them are broadening. And so today, the topic du jour is GLP-1s, has been for a little bit, but there will be another class of drugs that gets released tomorrow or the next day that impacts a variety of other conditions. And I think often we think about these things in isolation, like, hey, what is your GLP-1 strategy? But I think it's actually a broader thing of what is our strategy for dealing with the change in the way that healthcare is delivered, and how do we get out in front of that and have visibility towards it and plan for it, especially when a lot of those delivery mechanisms are not one and done. They are increasingly things that someone's going to take for a long period of time, where that employee may not be your employee the next day. And so how do we think about financing healthcare when the delivery of healthcare itself is changing? I think that's not necessarily a curveball, but rather an expansion and continuation of an existing theme.
Yeah, no, I love that. I mean, that's the unique thing about the employer market too. It's like, people are, only your employees for a short period of time, and you have to think about it differently than, other types of payers. So that's great. Well, thanks so much, John. I really appreciate you coming on. So again, John Zutter, CEO of Lantern Health. John, anything you want to say in closing?
No, just thanks for having me. It's fun.
Awesome.